Jack Bogle was a man with a vision. He believed that investors should have access to low-cost and diversified investment funds to help them from falling victim to any extortionate fund management fees. In 1975, he founded Vanguard, an investment management company that was dedicated to this vision, and in 1976, Vanguard launched its first fund, the Vanguard 500 Index Fund, its first Vanguard fund offered to the public. Later, in 1984, came their Total Stock Market Fund, designed to track the entire US stock market. In 1994 is where Vanguard saw an opening in the market, beyond just offering a low-cost solution. Vanguard realised that there was a gap in the market to provide a one-stop solution to investors. A set and forget investment fund that's fund allocation is designed to help investors reach their long-term goals with options to suit everyone's different tolerance to risk. The fund helped catapult Vanguard's popularity, and through 2000 to 2020, Vanguard increased its assets under management from $1 to $7 trillion. Just within the Vanguard LifeStrategy alone, it contained over $750 billion in managed funds. The fund contains over 24,000 underlying positions and ensures broad diversification over a combination of shares in companies and bond markets. It's truly designed to be the one-stop investment fund for any investor to buy. So the question is, if it's so good, why do I, someone who's been investing for nearly 14 years, not buy them?
Now that's a good question.
This is something I've been asked time and time again, so I think it's time that I explain my reasoning as to why I don't buy them, and the last is the most important that you may not even have realised is happening. First off, let's talk about the herd mentality. When you first learn about investing, if you're lucky enough to get that far, the phrase you're likely going to hear next is Vanguard.
Vanguard.
And the most common question I get asked is, Vanguard's pretty good for investing, isn't it? Followed by my question of a Vanguard fund or the platform, to which most people don't know the answer. Vanguard has created this investing bubble in which the majority of people think only Vanguard exists. The amount of people who don't realise you can buy most Vanguard funds on nearly all investing platforms is quite staggering. There's also other fund providers who are cheaper than Vanguard but get overlooked because of the sheer popularity of the Vanguard name. So once you fall down the rabbit hole of Vanguard, you're likely going to go in one of three directions. Direction 1 is the S&P 500, the fund that everybody talks about. The top 500 companies in America that have historically returned around 10% per year to investors. Direction 2 is VWRL or VWRP, one of the two all-world funds that pay out a dividends either to you or reinvest them automatically. This still has around 60% of the US included, but it's classed as more diverse and possibly a safer investment and returns around 8% per year. The third is the Vanguard LifeStrategy funds, which are designed to do it all for you. Or alternatively, you've gone for a combination of all three with no real idea of why. Now, whichever one of these you have, don't worry, because none of these are bad options by any means, unless you've got the LifeStrategy completely wrong, which we'll discuss shortly. What I think you might find quite shocking though is to hear me say that I think the Vanguard LifeStrategy is fundamentally flawed for two main reasons. Here are the Vanguard LifeStrategy options. Now let's bear in mind the LifeStrategy is designed for a beginner investor. Now you tell me, as a beginner investor, would you have any clue which one of these to go for? You've got the 20, the 40, the 60, the 80 and the 100, all with different kind of percentages allocated to stocks and some to bonds. Although Vanguard does give some guidance below about the level of risk to the reward, I'm not convinced that for the beginner investor, they would know which one of these they should be aiming for, yet alone what a bond is. Can you sit there today and hand on heart say that you know what a bond is and how they work? The bond is designed to help balance volatility in your portfolio. So for example, if you take a higher percentage of bonds, the idea is that your portfolio won't be susceptible to the market conditions. Now, it doesn't always work like that, but the idea is when stocks go up, bonds should go down. Unfortunately, lately, bonds haven't quite been performing in that way. But in general, the idea is that the two counteract one another to give you some sort of balance.
That's what I'm saying, it's in the balance.
If we take a look at this, we can see that in some years bonds have done better than stocks, and other years vice versa. But trying to decide what level of bond allocation you need is actually quite difficult. This is where I don't think the LifeStrategy is the most beginner friendly. In actual fact, if you want a complete hands-off approach, you'd likely be better with one of Vanguard's target retirement funds. You essentially select the date you would like to retire, and it will automatically adjust your portfolio allocation by year to make sure you meet your retirement goals with as minimal risk as possible. You'll have to pay an extra 0.02% for doing this, but it may be worth the added cost for you if that's something you're looking for. Now this is a point where I tell you, although I think bonds are good, they aren't for me. When you look at the growth of bonds from 1919 to 2019, well, bonds have returned $8,914 on a $1,000 investment. The same $1,000 invested would have returned you $2.2 million in the S&P 500. Also, the huge glaring problem is to me, when you compare all of the LifeStrategy funds side by side, it's clear that the more bonds you decided to hold, the worse your portfolio would have performed. From a 203% return if you went from 100% equities, or just 52% if you went for the 20% equity option. Now of course there's no guarantee the next 15 years are going to look like this one, but according to Vanguard's 10-year forecast, Vanguard is expecting the US and international bonds to deliver 4 to 5% per year, while at the same time their models are expecting higher returns for non-US markets and emerging markets, 7.2 to 9.2%, and for the US market they're estimating 4.7 to 6.7%. What this means is even though they're expecting bonds to perform better than they have been doing, they're still expecting them to underperform a world index fund. Now it's worth pointing out here that bonds, despite delivering lower returns, can actually be quite important. If you're within 10 years of hitting your retirement goal, depending on your position and appetite to risk, you may want to include more of them. Likewise, if you're retired, then bonds could be a useful income tool, as can dividends. But if you have over 10 or a 15-year timeline, in my case 20, it's more likely that you'll get better returns just focusing on global equities, in my opinion. So let's say, for argument's sake, like me, you don't need bonds. And this is where the decision becomes harder. The question becomes, what about the LifeStrategy 100, i.e. fully invested in stocks, compared to something like VWRL, the Vanguard All World Fund? And the annoying thing here is you would buy the LifeStrategy on the Vanguard website, and you have the option between the accumulation and the income, i.e. to automatically reinvest the dividends or pay them out to you. But for the All World Fund, you don't have the option, frustratingly. So although we ideally want to compare the automatic reinvestment, we have to compare the two income funds. The LifeStrategy does pay a slightly higher dividend, but I think for this case it's kind of negligible. I'm not going to compare the S&P 500 here because I feel it's not a particularly fair comparison. And in fact, some people may argue comparing all the LifeStrategy funds side by side also isn't fair. But I think when choosing which one to buy, it's kind of important to do. So first, let's look at the returns. Over the past 10 years, the Vanguard LifeStrategy 100 has actually outperformed the Vanguard All World Fund, 203% versus 173%. But over the past 5 years, VWRL has actually been the winner. This is particularly for one reason, in my opinion, and this is actually why I don't want them. The LifeStrategy is actually highly weighted towards the UK, and you can see in certain years the weighting has helped outperform the World Fund. In fact, when you look at what's held within the LifeStrategy, these 3 positions alone make up a 25% holding in the UK. Whether you want this or not is pretty debatable, but personally I don't feel the growth that's going to drive the future is going to come from the UK, at least not yet. I also don't feel that the UK makes up 25% of the world. In fact, when we look at the global GDP, the UK only makes up around 3.1% of the global world's economy. Of course, I'm not saying this is how we should split a world fund, but allocating 25% just seems a little too high to me. It's worth pointing out here that there's actually an advantage of holding more UK home currency based funds, which I think is a personal choice, but for me, I don't want 25% of my investments to be in the UK. If we go off Vanguard's own predictions, it's predicting the UK to do 4.6 to 6.6%, but it's still expecting global equities to do better at 6.1 to 8.1%. So when you look at it like that, it seems a bit of a no-brainer. There's also a couple of things I want to point out with the LifeStrategy that I can't particularly confirm or deny. If you can, please feel free to add references in the comments. First is that there are some hidden transaction costs. An article pointed out, in particular for the LifeStrategy 60/40, these are an additional 0.11% on top of the 0.22% fee. This is stated on the Vanguard website under transaction costs, and a European ruling has come out to help improve transparency. But it's also very difficult to find and compare these. I wouldn't worry about these too much, but it may be worth bearing in mind that there will be a transaction cost on top of the 0.22% fee. There's also, which I suspect to be true, a 20% rule. that you can only hold 20% of a fund within another fund within Europe. This is why you'll find most funds within others just to be shy of 20%, around 19%. This begs to differ whether if this wasn't the case, would the fund allocation still remain the same, or would there be less funds at higher percentages? I'm not 100% sure if that's true, but when you look at all of the percentages being about 19%, it does kind of raise suspicion. Another thing that really puts me off LifeStrategy is the gatekeeping. LifeStrategy is not particularly accessible on low-cost providers, mostly because the LifeStrategy is not an exchange-traded fund or an ETF. Instead, it's a combination of different funds that Vanguard offer, a lot of which you can't individually buy on other platforms because, again, they're not all ETFs. So by doing so, they're essentially forcing you to use the Vanguard platform, which is good and fine, but on Vanguard there's a 0.15% management fee, capped at £375 for the year. Now the issue this creates for me is my current portfolio would give me a £271 a year fee to use Vanguard. That's going to grow, and remember, it doesn't just stop when I retire. It will keep being charged while I have my account open, and once it reaches that cap, I will remain at that figure. So let's say I have all of this till age 80, if I'm lucky enough to live that long. That's £17,210 in extra fees because I'm forced to stick on the Vanguard platform. Of course, there will be ways around this, like using other platforms and being clever with the fees, but if I stuck with Vanguard as they would like me to, that's what the low-cost provider will charge me. The other consideration is I would rather go for VWRP, which is the accumulation version of the fund, so it automatically reinvests the dividends, which of course isn't available on the Vanguard platform. But even then, I could opt to recreate VWRP myself using two key funds, which gives me almost an identical holding with roughly a 0.13% fee compared to 0.22%. This may not seem like much, but from a rough plan from now until retirement, that will save me just shy of £30,000 until age 55, and possibly even more going forward from there. And if I decided not to use Vanguard altogether, then I could probably get it even cheaper. I think the fees generally aren't all that bad, and any of these options are far better than some of the other extortionate funds you'll find on the market. But even so, if I could save nearly £50,000, I would rather do it.
Who wouldn't?
Something that was quite a big thing for me is, realistically, if I had the choice, I would go all in the S&P 500, but I'm aware that's not the safest option. So the next step down for me would be something like going for an all-world fund. But then if I was to look at something like the LifeStrategy, that's almost another layer of safety down again. So for me, the VWRP seems like a safer middle ground. I'm a bit more exposed to the US market and have more exposure to risk, but also I'm not going for the ultimate more risky strategy. Although I'm pretty sure if you're fully in the S&P 500, you're still going to do pretty well. Another huge benefit of LifeStrategy originally was rebalancing. The fund automatically rebalances your allocation to a set percent of each fund. This may be particularly helpful to keeping it under the 20% rule, but it's also very helpful to keep your portfolio at the desired targets. Originally, this was very difficult to do, but platforms like InvestEngine now include rebalancing, so you can do it yourself, which I'm opting to do. But that being said, I don't particularly want you to feel worried. If you have LifeStrategy, it's not really a bad option at all, and it is splitting hairs. For me, like I say, it's the UK weighting and the fees I'm looking to avoid. If you feel like you need a hedge, you can opt to throw in 20% bonds to your portfolio. The outlook isn't bad for bonds at all, or even right now, you could get a cash account which is earning a solid percentage. Both can help reduce market volatility. For me, because my timeline is fairly long, over 20 years, I'm happy that when the market dips, it will just give me an opportunity to buy more stocks at a cheaper price. I hope this has helped answer the question that everybody asks me about why I'm not using them. If you have any questions about LifeStrategy, let me know, and I'll be creating a video shortly about my 2-fund strategy that will save you on fees. So if you aren't subscribed, make sure you do, as that will be coming shortly, and check out my latest portfolio update because I will have another coming soon. Thanks for watching, and I'll catch you in the next video.